Okay, welcome everyone. We're going to do a tutorial and a Q&A talking about the SPY advisor models that we've integrated into the platform. The 25 model and the 33 model, that's what we're naming them, are both on buy signals as of January 13th. And you can see they uh, came down to a 50% reading and a 67% reading respectively as of May 25th. So that just means that that's the laddering portion of it, which I'm going to explain. You can find these readings, of course, up in the left-hand corner of the platform, and those will change as the readings change. They'll change on a daily basis, or certainly or by the weekend. So you should check on Sunday night and then every day during the week. The STEM model, of course, is also up there. That actually improved today. We just improved that to orange. So I want to go over these advisor models, and it may seem a little bit complex, but I think once, and that's Bob Weissman telling me to record, and I am recording. Um, once I explain these to you, I think you'll understand how they work, and it's actually pretty basic, but it could appear complicated if you don't understand. But the first thing I want to point out is that three of the components of the 25 model, the 25 model just simply, the reason why it's a 25 model is because there's four components and it moves in 25% increments. Basically, each of the four components can either be on positive or negative, a buy or a sell. And there's three of those components are calculated daily, and one of them is calculated weekly, and that's updated by Sunday evening. The other ones are updated each night. So there could be a signal that happens during the week, but there also could be a signal that happens on the weekend due to if that one model is the triggering model, then it would happen on the weekend. Now, so your action should be taken in the performance that we show when we show the graphs of the performance is based on taking your position the next day at the next day's close. So you can even take it at the next day's open or intraday. Certainly, if there was a buy signal and the S&P was down in the morning, you'd get a better price. Maybe you get a better price. Who knows? It might close down, but you could take it. But you want to take it definitely by that close after the signal. The 33 model is the same thing as far as updated. One is updated on Sunday, but only two are daily because there's only three models, and it requires a larger percentage of the models to be bullish to get a buy signal, which I'll show you in just a second. But same thing, action should be taken the next close after the signal. So let me explain to you each of them, and then I'm going to show you a chart and show you the allocation and how this works. The 25 model generates a buy signal at 75%. So when it goes to 75%, that means that you should go to 100% invested in the SPY, in the ETF. Now, a sell signal is generated at 25%, and that would mean a sell signal would mean that you go to 100% cash. So the caveat is if the model goes to 100%, and it can go right to 100%, it could go from 0 to 100%. We don't know exactly how it's going to happen on any given day, but it can go right to 100%. If and when it goes to 100%, once it gets to 100%, you then switch to what we call a ladder, and it would ladder down from there and even back up until it hits a 25% sell signal. So very simply, it goes 75, you go to 100% invested. The model goes to 100, you don't do anything because you're already 100% invested. But let's just say a month later, it goes to 75%. Well, now you raise 25% cash. And now you would ladder up and down. Maybe let's say it goes back to 100. You would move that back into the market. You'd be 100% invested. Now it goes down to 50. Now you raise 50% cash until it reaches the 25% sell signal. At 25%, you then go to a 0% invested position. So, and now once that's achieved, you now have to wait for the 75% buy signal again. So now, if the 100% is not achieved, let's just say it goes to 75 and it goes down from there, you're not laddering. You're just waiting until the 25% sell signal. So from 75, 25, it's buy sell. The only caveat is if it goes to 100, then you ladder down to a sell signal. Let me show you how that looks. So I'm going to look at the period back here, 2000 bear market. We got this one signal. It was actually a false signal during that bear market. We went to this A right here. You see it goes to 75%. But if you look at the allocation down here, see it's 100%. So that gives you a 100% exposure. But then it moves down to 50 and it goes to 25. And that's where you see it dives all the way back down and goes to 100% cash. Now you have to wait. You wait until it gets to 75 again. Well, here at point C, it goes to 75, right? That's a buy signal. And now you're 100. See, the allocation goes right to 100. Now it goes to 100%. Nothing changes. But all through the next period of these several years, you're laddering back and forth. So you would raise some cash here. You go to 75, you'd go to 50, then you go back up to 100, then you come back down, and you would just be laddering back and forth. And this seems like more than it really is, because this is a period of years. The average signal, I think, is about 1 per year. But with laddering, you certainly can go in and out, maybe 3-4 times a year at times. There could be some, some whipsaws, but this is what keeps you moving into cash off the highs. And this is the protective measure that keeps you from getting, I can't say up with a guarantee, but there's a very good chance that you will move into at least a portion of cash before any kind of swift decline. And the sell signal is designed to get you out before any really big bear market. So you sort of have this double protection mechanism that we've built in. So then you're laddering back and forth. You go back to 100 until now you go down to 25%, boom, sell signal again. And you can see it stayed on that sell signal through the entire bear market of 08. And then you wait for a buy signal. You see it comes back up here and goes to 50%. You don't do anything until it gets to 75. Then once it goes to 100, you go back to laddering again. So now let me show you the 33 model. The 33 model is easier. It's basically the same concept, but you go 100%, has to go to 100% to hit a buy signal. That's basically all 3 models. And all we did was just drop one of the models. It's the same as the 4. It's just we just dropped one of the models. Now, with the 33, you get a buy signal in 100. Once you hit 100, you go right to laddering. You ladder all the way down until you're at 0. Okay. Once you're at 0, you've now got to wait for 100% buy signal. The reason why we did this is that, once again, to get you very quickly out of the market and raising cash into a decline, but to avoid the noise. And I'll show you real quick here. You can see there's all this noise around the bottoms, all this noise. There's a lot of false signals that can happen, especially in a big bear market. And we've weeded out that noise. So you have to have a certain requirement, but we want to make sure that we're moving into cash off the highs. We want to make sure we don't get caught into an 87 type crash situation, and certainly want to get out before a big bear market. This model, it performs about the same, a little bit better maybe, and because it moves in bigger increments, and there's only 3 increments, you're going to ladder into cash faster, because it's going to go from 100 to 67 to 33 to 0, as opposed to in 25% increments. Either one is going to get you about the same results. One might have you in more cash, a little bit more cash than another, but they're both going to be very similar. I would prefer the 33 myself. It's easier. If I were to follow these 2, I would use the 33. Let me show you how this works. So you can see from a 0% reading, it takes a 100% to get to a buy signal. Once you get to that buy signal, you're just laddering. All through here, you're going from 100% to 67, which you'd raise 33% cash, back to 100 for, I don't know, the better part of a year or so. Now you raise some cash. And these are going to happen during probably small, intermediate, short-term corrections. You're bending with the market, and now you come back 100%, back and forth, until finally you come down and you get a sell signal. Right now, you can see the model goes to, during this time, it's just the model is mimicking the exposure is mimicking the model exactly. Right now, you go down to 100, you go to 100% cash. Now you can see how we come back up here, and you get to 66%, 67%. there's no signal. You see, you're still in cash because you have to wait for the 100%. Then right here, the 100% comes. Once that 100% comes, you just go right back to laddering. And your quote unquote sell signal would be at 0%. Once you get to 0%, then you would wait for 100 again. So it's a simpler model, very straightforward. You can see that the buys and sells are pretty much identical. It's just a laddering portion, which is going to, percentage-wise, move you out and in of a little bit larger chunks at a time. And that's basically it. I mean, it's and again, we've looked back to optimize the use of these 4 models, but I have actually been following these models for the better part of several decades, and some of them for 30 plus years, going all the way back to the early 1990s. So I sort of lived through these trend models and have been using them on my own, and then put them together into this model. So it is there is a, I don't like to use the word back test. I don't like the back test, but we did optimize the use of the way we use them, but we didn't go and just look for models that, we went and back tested and see what works. This is something that I've actually lived through in real time and saw it with my own eyes, and it makes a lot of sense. The components of them are just simply trend following. So this is a purely technical strategy. And the real key is, you can see that during the bear markets, you can see how we go flatline pretty much. And there's definitely going to be some dips because you're going back and forth between the exposure. But you can see relative to the bear market, you're having very little drawdown. As a matter of fact, this particular model, the max drawdown through this whole period studied here is about 19% versus a much larger drawdown through these bear markets. And that gives you the outperformance, because when you go in the market and you go 100% invested, you can only perform as good as the S&P 500, right? Because you're not leveraged, and you're in the S&P 500. So you're going to mimic it exactly. Where you pick up the alpha is when you're out of the market. And that's where you get the outperformance. But this is for someone, especially, maybe you're nearing retirement age, or you just have an aversion to risk. You don't want to work for your whole life and put money into your 401k only to find out just before you're about to retire, we run into a 2000 bear market situation where the S&P goes down 50%, and now your wealth has been cut in half, and it takes 5-10 years to even come back to break even. At the worst possible time, you now have got this big decline in your 401k. This was designed around that, to give you some protection against that, to be able to avoid those type of down markets. So the real key of this is avoiding the bear markets. That's our goal. Our goal is to be in the S&P 500 as much as possible, but just to be out during the big declines. And the price to pay for that is a little bit of whipsaw back and forth during the up markets, which will cause a little underperformance in the up markets, but a lot of outperformance in the down markets. So I hope this explained it, and I'm going to find out how well by looking at some of your questions here. So if you guys have questions, this is the time to ask them. Let me just bring this up. Let's see. Okay, so Mark mentioned the general market recording, something about that he would be concerned if the SPY ran up quickly in the immediate future and would decrease the SPY model. Can he speak a bit to the input that he's looking for? I don't understand what you're referring to. And the market moving up would not, there's no overbought, oversold component in this model, because that's very dangerous. And it also will limit your upside, because markets can become extended and overbought for a long period of time. This is a pure trend following model, and it's going to pretty much move in direction with the market. So you'll get a sell signal on the downside, you'll get a buy signal on the upside. You're never going to catch the high or the low, but you're looking to catch the meat of the market. So I'm not sure what comment I made. I can't really speak to that because I don't recall making that comment, and it wouldn't make sense with this particular model. So Bill's asking, if the model's at 75%, how do we know if it's just coming up or if it was just at 100% and we're now laddering? Very good question. Very good question. And we're gonna talk about this each week, and that eventually this may be a separate type of, when I say product, we may sort of have a session or some type of newsletter situation around this as a 401k advisor, and then we would talk about that and always let you know where it's at. But once you get in gear with it, you're pretty much then you'll know where you're at. So we'll have commentary around it too. So that's one of the reasons to watch the study sessions, and maybe we'll have some commentary in a section. We can put that on the site where it's a special section dedicated to this. Let's see, Josh, has there been research done with these signals back into the 70s? Just curious what it looks like in a choppy general market like that. Well, the 70s actually is a great market for this type of environment. The only environment that really would cause a problem for this type of market, and we have tested, see, the reason why we don't have it all the way back is because not all the models go back that far, but I believe 2 of them go back to 1909. I know one of them definitely goes back to 1909. That's the one I've been following for 30 years. So one of them goes back to 1909. The period of the 20s, the very volatile depressionary period, that caused a problem. And again, you would probably just underperform. It's not like you would have got annihilated in that market. You would have avoided the big declines, but there was a lot of whipsaw action. Look, there's no free lunch. There is no free lunch. A real choppy market is going to chop up a trend indicator, and that's the trade-off. But there really isn't an alternative. You either you can have guesswork or you can go with the trend. And you've got to, there is a price to pay, and that's the price to pay. But it should do a good job of keeping you on the right side of the market. Let's see, how or when can you get in if you missed the initial buy signal, if either the 25 or the 33%? It's a great question, and there's 2 answers to it. One is you can wait for a reset. Okay, if you're on a buy signal, you can wait for the next sell signal. I wouldn't suggest that. I think, you maybe, you top ticket in the short term. Maybe it's, it's on 100%, it's been running up and you buy it, but I would just go in at the percentage that it's at. And or take a look, if it's laddered itself down, it was at 100 and it's laddered down to 50, just go to 50, and that's how you get started, because you do have to get started at some point. This is really meant for very long-term time frames. You shouldn't be too concerned about getting whipped around in the short term, because this is really a very long-term strategy and a long-term model. It's not something that I'm putting any big amount of money of my own net worth in. I have a 401k and it's in bonds. It's a minimal amount of money compared to my trading money, which is many multiples above it. But I have that write-off that I can put money into a 401k and so forth. So I do it. I just roll it in treasuries. And I trade my bigger account. I'm more interested in individual stocks. I do use this. I'm using this now for my daughter's account. I have a long-term account for my daughter, and so that's what I am now using this particular model. So I am trading my daughter's account off of this model. I was thinking about even maybe doing a real money Minervini private access account where we actually trade a real money account with this, because this is one where it's absolute specific allocation, it's mechanical, and we can track it exactly for a track record. So we may do a real money account and just track it. Let's see, how do you suggest we enter into from 100% cash position? So again, I would say, like right now, maybe you just move to the to the percentage that it's laddered, because that's where you would be. I mean, if you were, if it went, once it goes on a buy signal, whatever percentage it's on, if it went from 100, of course, that's where you would be. So I would just go into the model wherever it's at the time. And that would be my suggestion. You certainly could wait and just wait for a reset. Which of the 2 models would you pick as a conservative investor? They're both very conservative, and there's a conservativeness in each one. The conservative nature is just slightly different. So the conservative nature of having the 25% and moving incrementally is conservative in the way that it moves incrementally in smaller increments. So you're not making as drastic decisions. However, with the 33, it's conservative because it's going to more quickly get you out if the market starts rolling over. So I prefer the 33. If I were to have to choose, I think I would choose the 33. That's the one that I'm trading my daughter's account with. Let's see, what is laddering at 33 with the 33 model? Go completely out or go to 33% invested? I think I already answered that and showed exactly how this works. So I'm not sure exactly what you're asking, but I think I answered that. Would you prefer S&P or S&P EW? Equal weight? No, definitely definitely not equally weighted. You're going to go with the S&P 500 market weighted. That's a great question. I would not go with the equal weighted. Go with the S&P. Can I follow the same models for the NASDAQ 100? No, we don't have data to be able to support that. Whether it works or not, it may. I certainly, if this is on a buy and the SPY is moving up, and if it moves up a good deal with a bull market, you're going to get the cues and you're going to get some upward movement. But I don't know if it will relatively outperform or underperform. This is a specific S&P 500 model, and I'm much more confident and feel better about the S&P 500 than any of the other indexes. Are dividends factored into the returns? I believe they are. I believe they are. They are during the period that you are long. I got to make absolutely certain, but I'm pretty sure that was the instructions that I gave. And they're going, when it goes into cash, it's going into 3-month T-bills. So you'd move into a money market. For a good period of time, that didn't really mean much because we were in zero interest rate environment. In certain environments, it's going to give you a little bit of return, and you'll actually see when it's in cash, you see a little tiny bit of upward movement, and that's that interest rate that you're getting while you're in cash. Let's see. When it comes to the 33 model, one should ladder down on 33% chunks or 100% until zero, or until go to 0% exposure once a 33 sell signal is triggered instead of laddering down to zero. So I think what you're asking is, do you go down to zero, or is it a 33% sell signal? It is not 33. It has to go to zero. Zero is the sell signal. So you just follow it lockstep. Once it goes to 100, from that point, you're 100% invested. You're just going to mimic the model. If it goes to 67, you're 67, 33, 33. Once it goes to zero, then you don't ladder up. You only ladder up above zero. So from 33 back to 67, back to 100, you're laddering. But once it hits zero, you reset. Okay, and that's how we're getting rid of a lot of this noise and these false signals around bottoms. Real money MPI account would be great. Yeah, I think so too. I think we'll probably do it. Maybe I'll do like $100,000 account to start. It would be interesting to see where that is, down the road, 5-10 years down the road, see where that $100,000 goes. Let's see, 25 miles at 50%, another notch down, it will trigger sell. How likely that is in your opinion? I mean, that's the whole reason why we have this type of model is so we don't use opinions. So I mean, there's no reason to worry about that. You're most likely, the nice thing about the S&P 500 and this type of strategy is that it's very unlikely that you're going to have a big giant decline before you get either moving into cash and laddering in that direction, or getting a sell signal. If you're at 50% and it goes to a sell signal, probably the move down that would cause that would be single digit percentage, maybe even low single digit percentage. Certainly it could be more if you got a quick slide, but that's the whole idea of this, is not to think and to just we're trying to be, we'd like to just hold the S&P 500 as long as we can. That's the goal. The goal is to be in the S&P 500 as long as it's performing well, and go through as many of the short-term pullbacks and corrections as we can. We just don't want to be in the big bear markets, and because that's where you've got to do all that work to get back to break even, and you're not compounding on your returns. You're not stair-stepping your equity curve up, and that's where it just might be the wrong time for you, where you need the money. You're going to buy a house, you're going to retire, and then during that particular time, it just happened to hit it at the wrong time here. It was doing great for 20 years, and now when I need the money, the market gets clobbered, and you're sitting at a big loss, and it takes a decade to get back. And that's what this is trying. Its goal is to protect against. I think that's pretty much all the questions. I mean, it's pretty straightforward. It's pretty, simple once you understand it. Like I said, it's not magic. It's not a magic formula. I think it's a really good formula. It's going to keep you on the right side of the big moves. There's noise in between, and there is some price to pay, but you can see minimal buys and sells, and a lot of this jockeying back and forth. Yeah, when you look at the equity curve, it doesn't do much to hurt you. Even though, yes, it is going to give up some return, but you get that outperformance on the downside in the big bear markets, and you see over time you're outperforming. And the bigger the bear markets are, the more you outperform if you avoid those. So the question is, what's the outperformance compared to the S&P over the years? So you can see gain per annum here is 13.45%. I believe over the same period, the S&P was about 11 change, or maybe 12.1, I think it was, or 11.65. Those are the numbers I remember. But you can see how that adds up. I mean, this is in the neighborhood of 20 some odd thousand% versus 10 or 12,000%. Over time, it really adds up, that difference in return. But again, 13.45% return. If this model could maintain that, that's a home run. That's, for this kind of conservative investment, that would be a home run. I think anything double digit, especially when you go risk adjusted. See, that's the real key. Risk adjusted. Risk adjusted. This return is off the charts, because it's not only outperforming the S&P, but it's also doing it with way less risk, way less standard deviation, and far less drawdown. So the risk adjusted return is really, really high. Which two models of the 25 model are currently positive? Well, I haven't even named those, or so I'm not going to tell you that, because that's not something that's of a topic today. But they're all trend models. So they're all trend-based models. And they're meant to complement each other. That one will catch at a certain point. And some of the models have many components in them. One has a lot of components. One of them has 4 components. So this is the net of a lot of different things measuring the market. In total, over 30. Over 30 different models make up the whole thing. Let's see. Quick strategy: if the stock moves 3 to 4% up, the buy point should be moved. The stop loss to break even. Okay, that's a question that's not pertinent to this conversation, so we'll save that for the next Q&A. With the SPY pointing down and the SPY pointing down, do you mean we wait? No, that's just, again, see, here's the thing. If you're getting some noise in between, and depending if you're on a buy signal, if you get on a buy signal on the 25, you go to 75, and then you go to 50, you don't move down. You stay at 100%. Only when it goes to 100 would you, and then you would move down in lockstep. So that's why that direction is just telling you which way it went. Does dollar cost averaging factor into your model? No, not at all. No, this is straight, just following the buy sell signals, 100%, 0%, and then laddering from these levels. This is really a unique, this combination of buy sell signals and laddering is something that I haven't seen anybody do in the manner. Ned Davis tracks this for me. When we pay Ned Davis to do the research, and then to track the models, and then report them to me. And so far, all their analysts that I talk to, they've never seen anything like this, and they're very intrigued, and think that it's a better mousetrap. So we're really encouraged by this. Okay, so I'm going to run. To get back to, I'm actually, for the first time today, doing some of my own trading. I'm buying some of the names that we put out here, and so far so good. Things are looking pretty good. I've traded a few names here, so trying to get some toes in the water here, and hopefully we keep moving in this direction. You see the Russell 2000 actually improved quite a bit in the last 2 days. That's that rotation that I said to expect, that we might see that, and we're seeing some of these stocks firming up. Hopefully this is better times ahead for individual stocks. We'll take it one day at a time. I hope this has been helpful. I think we're going to put this up for a replay so you can watch it again if you need to, and then we'll probably just do it again. Thank you, Renee, and we'll monitor the platform. Okay. I'll see you guys later. Bye-bye. And I'll try to do another Q&A if we can on the general a general Q&A if we can when we get time this week. All right. Talk to you later. Bye-bye.